Hey folks, Dan Frio here with your market update for August 2nd, 2024. So in today's video, we're going to explain how the Fed is basically controlling the whole economy right now when it comes to housing, the equity markets, and they have also a big role in the world. But you might wonder why the Federal Reserve was even created, because it's not a federal agency, it's not a reserve, and it's not a bank. So why were they created? Well, if you go over to Chat GPT, which you know I love, it actually tells us right here, what's the Federal Reserve's two mandates? Why were they created? One was maximum employment, and the other was price stability, which is AKA inflation. Well, the data that we've been getting so far in the last couple of weeks was on price stability, the inflation front, and it's been coming down. So the catalyst right now, or the oddball out, is the employment numbers. They've been basically robust until this time. So today we had a huge employment number come out. I want to take it over to CNBC, let Rick Santelli tell you about it. So when we come back, I'm going to show you the market reactions and what my expectations are for mortgage rates. Is this going to push housing affordability down a little bit for you guys? I think it will. So without further ado, let's get over to CNBC. Rick, take it away. Give us the numbers. And then, like I said, when we come back from this video or this interview, I'm going to put all this into context for you so I can explain to you exactly what's happening. So, Rick, take it away, buddy.
It's time for the July jobs report. The over keeps coming in, Rick. Which is it?
The under wins.
Oh,
the
good.
under wins for the July jobs report. Non-farm payrolls comes in at 114,000. 114,000. Of course, that is the lightest level, going back to minus 243,000, which was Dece of 2020 in the pandemic-affected months, of course. Now, if we look at the unemployment rate moved up to 4.3. Moved up to 4.3. That is the warmest it's been since October of 21.
The Fed's going to like this because remember they were wanting to the unemployment rate to go up, and they said at first 4, and then they said a little bit higher than that. It's now 4.3. So I think it's high enough at this point.
October of 21. And if we look at revisions, I should bring that out rather quickly. We see that last month's non-farm moved from 206,000 down to 179,000. Now, let's look at average hourly earnings month over month, up 0.2, 1/10 lighter than both rearview mirror and windshield. If we look at up 0.2, that is the lightest. It equals April. You have to go to February to find a smaller number when it was up 1/10. Let's take a macro and go year over year on average hourly earnings, also coming in light, 3.6. 3.7 was expected. 3.9 in the rearview mirror becomes 3.8. 3.6 going into the Wayback Machine. You have to go all the way back to May of 21 when it was 2.3. So big drops there. Weekly average work week for all employees comes in at 34.2. We also lost 1/10 there. Week shortened a little bit. 34.2 equals where we started the year out in January. To find a smaller work week, you have to go to March of 2020 when it was 34, right on the nose. Now, let's look at the participation rate. This is always important. And good news here, we're expanding, we're pulling some more in, 62.7. That equals where we were in April. To find a higher number, you go to November last year at 62.8. And finally, U3 was 4.3. U6, the underemployment rate, moves to 7.8. That is a huge jump from 7.4. I'm going to have to go into Wayback Machine here. 7.8 would be the highest underemployment rate, U6, since it was 8.1 in October of 21. We see that this weak data joins other weak data in pushing yields down. And what is notable here, and this is big time, 379 on a 10-year. Where did it close last year? At 388. It moves into the black and joins other maturities. That 2-year closed 4.25 last year, and of course it's trading right now at 387. And just to show you how huge these moves are, gang, 386 now in a 2-year. It closed at 438 last week. 10-year at 378, 379. It closed at 419 last week. So you could see these are historic rate drops, and they do portend the easing cycle that may be built in for factors that seem to be all about weakness.
So weakness. So did the Fed miss it? Did the Fed miss this? Should they have cut already? Well, let's take a little bit of a deep dive into what he just went over. And there's just basically three main numbers we're going to focus in on. Average hourly earnings went from 0.3 to 0.2. So earnings are coming down. Number of job payroll people in the payroll was 175 previously, or 179, 114. This is brutal. And then the unemployment rate went from 4.1 to 4.3. So all this is basically saying the job market is just falling off a cliff at this point. So now here's what you're going to start seeing. You're going to see, okay, now nobody's working, nobody's making any money. Everybody's going to go into foreclosure and bankruptcy and things like that. Guys, relax. Okay, so what this is telling us is rates are coming down. The economy's cooling. It's cooling quite a bit. Let's go over to the markets to see how they're reacting. Dow Jones down 400, S&P down 100. The S&P usually doesn't drop that much, and NASDAQ continues its drive downwards, down 3% over 500 points. So that's what we're seeing right now in the broad indexes. But the good news, like I said, the good news here is rates are coming down. That's one of the big catalysts with the housing market that we needed, because house prices aren't following suit. A lot of people have been predicting a housing crash for 3-4 years now, and it's not there because of no inventory. Well, this reduction in rates is going to start helping dramatically. So now let's get over to the Federal Reserve. I want you guys to understand what the Federal Reserve controls. Okay, so when they come into the market and they say, okay, we're going to cut rates, what exactly are they cutting? Okay, they're cutting one thing, and one thing only. It's called the federal funds rate. Currently, that rate is 5.33. Okay, so what is it exactly? Well, the Federal Reserve created this because banks at some point need to get money. So let's make a perfect example of this. Let's say Bank of America at the end of the day, and now this is a fictitious situation, but let's say Bank of America at the end of the day, they need just $1 million to close the books to prove they're solvent. Okay, so they don't have it. So they have to go out to another bank and get that money lent to them so they can close their books for the day and be solvent. Okay, what interest rate do they pay on that? They don't pay the 28% that we pay on our credit cards. They pay 5.33%, the federal funds rate, okay? So what happened yesterday or the day before when the Federal Reserve came out and said, we're not going to cut rates? All of a sudden, there's a tool that we watch here. Oh, shoot, I blew it. But let me show you this. A lot of people follow the CME FedWatch tool. Now, we've been watching this for a couple years, so if you've been on my channel for that long, you've already been privy to this. But what it is it's right through here. The CME has a FedWatch tool, and it's basically the next Fed meeting is in 47 days. Okay, what this tells us is what the likelihood the Federal Reserve will change the federal funds rate at the next meeting. Well, here's the kind of the issue that we have right now. And I won't say issue, it's great news, but with great news is always bad news. Okay, so let's go over here. Remember, the federal funds rate is right now at 5.33. So it has a range of 5.25 to 5.5. Okay, so here's what the markets are telling us right now. They're saying let's go back to this. Let's go to the probability charts. So I'm at the CME FedWatch tool. Here's what you're seeing right through here. So what this is telling us that the 5.25 to 5.5% chart that we're seeing, or we have been seeing, it's gone. Let me pull this in for you guys so you can see this. So right through here, it used to have one more column over in this section that was 5.25 to 5.5. It's gone. And now look what's happening. Not even the 5 to 5.25 is the sweet range right now. The markets are actually anticipating now a 50 basis point cut to rates. You can see that's a 62% chance there. And then look, multiple cuts from there. So where it's going to be September, I can almost assure you that there is a 100% chance they're going to cut rates. Now, what are they going to cut it? 1/4 or 0.5%. That's that part of the equation that I want to show you guys. Okay, so now the next piece of this is you're going to start seeing or hearing, well, the inverted yield curve is going to or creating or signaling a recession. So what exactly is the U.S. yield curve? Okay, so this is what it means. Here's short-term rates. It's basically here's where interest rates are on short-term maturities. Things like 2 years, 6 months, 2-year bonds. And then when you go out to a 10-year, a 30-year bond, here's where the yields are. Okay. What inverse means is if you want to tie up your money for a longer period of time, most investors they're like, okay, if I'm going to tie up my money for 5 years, I want higher yields than if I were to tie up my money for 6 months or 2 years. So that makes sense because you're tying up your money long term. You want higher returns. Well, the inverted yield curve means short-term maturities have higher interest rates than long-term maturities. It doesn't make any sense. Okay, why would you invest your money long-term to get a smaller yield than you would on short-term? That's what's called the inverted yield curve. And usually when this happens, it signals there's a recession shortly in store for us. So we'll continue to monitor that. So how much would this affect your buying power? Well, we created a tool. It's called the Max Price Calculator. And you can get this tool right down below in my description. It's right through here. So check this out. You're going to be able to play with numbers, prices of homes as well as interest rates, because interest rates just, a couple months ago was 8%. Now we're teetering on, 6.5%. So this tool is going to be right down below for you guys to take advantage of. What you do is you go down through here and you plug in some content. In this chart, you're going to go through here and it's going to give you an introductory right through here. What you're going to do is fill in your information. This is perfect for you guys out there trying to figure out how much is my payment going to be, what can I afford. So you're going to go down through here. Most first-time home buyers need between 3 and 3.5% of a down payment. So you can manipulate that number right through here. So let's say I want to go with the 3% down program. That's a conventional loan for first-time home buyers. And you're going to put in a rate at 6.5. That's basically almost where rates are today. And you're just going to go down through here, put in how much money you earn. What are your monthly debts? And you can get that from your credit report. If you need your credit report, check out credit scores and more down below. You can actually order your FICO credit score from there to get what your mortgage score is. And then you put in all your debts. Okay. Then what it tells you over on the third slide, here's what you qualify for. And it goes down through and it gives you options. It says, on a conventional loan, here's what you would qualify for. Here's what your payments would be. Here's how much money you would need to close. And the list goes on and on and on. And it gives you a whole bunch of details. So next week on our live event, Kyle and I will go over this to show you guys, or if you guys are starting to contemplate buying a house now, this is a great tool to figure out what is your sweet spot on how much you can afford. So check out that calendar on our website. And if you want to kick the tires and you're like, hey, Dan, I really would like to see how much I would qualify for. How do I do that? Well, just reach out to us. How do you do? What's the best way to contact us? And it's me, basically, who you're reaching out to. When you're reaching out to us, there's me, Alan, and David. It's not a huge call center. We'd love to answer any questions that you have. So how do you reach out to us? We can go to therateupdate.com. Here's our website. Check it out. If you want to put in your application, you can do that right there. But the one thing I'd ask you to do is if you're a first-time home buyer, we have several grant programs. You can check that out right there. It's a grant program. It's a finder. Some of the programs are out there that are $6,500, and it's basically free money. We're going to give you $6,500 that you can use for a down payment or your closing costs, or you can even use that to buy down your rate, whatever you want to do. So we put all these tools at your fingertips to help you manage and navigate home buying in 2024. So that's my report for this morning. Don't forget to come back later this afternoon. I'll show you the results because rates are going to come down. Rates right now on the top 6 products that people use when they're buying their first house are right here. And you're going to see, let's see if the 30-year fixed has changed yet, because I'm expecting that might go down to about 6.5 today. Let's check to refresh that. Not yet, but I'll show you the results at the closing bell. Have a great morning, great afternoon. I'll see you about 2-3 o'clock with the closing bell. Have a fantastic day. Bye-bye.